On behalf of the Burkenroad analyst team covering Cal-Maine Foods, I'd like to welcome you to our Fall 2013 report. My name is Erica Salmrench, and along with my colleagues Pedro Ferreira, Eric Wilderotter, and Jeremy Jones, we hope you enjoy, learn, and profit from this report. This report will encompass a company profile, company and industry analysis, growth strategy, financial position, evaluation, and an investment thesis. Cal-Maine trades on the NASDAQ under the ticker CALM, or C-A-L-M. Founded in 1969 and headquartered in Jackson, Mississippi, Cal-Maine is the largest shell egg producer in the United States. 1 in 5 eggs are Cal-Maine eggs. In fiscal year 2013, Cal-Maine sold more than 940 million dozen eggs, translating into revenue of over $1.2 billion. With facilities in 16 states, primarily across the Southwest, Southeast, and Midwest, Cal-Maine produces and distributes eggs through familiar brands such as Eggland's Best, Farmhouse, and 4Grain. As of November 2013, Cal-Maine traded in the $51 range. Based on our analysis, which you will hear shortly, we rate it a market perform with a 12-month price target of $57. Taking a look at the overall industry, as of 2012, the U.S. egg industry was valued at $7.8 billion. Cal-Maine's portion of that is a sizable billion-dollar market cap. Demand for eggs is consistent with overall population growth. Industry growth averages can be assumed at about 1% every year. As expected, barriers to entry are high, particularly as the industry continues to consolidate. Cal-Maine's primary competitors are mostly smaller and family-owned companies. Overall, it is not a high-growth or high-margin industry. Cal-Maine's strategic growth plans, as outlined in their financial statements and in their communications to investors, focus on acquisitions and the growth of specialty egg sales. Since 2007, Cal-Maine's specialty egg sales have grown at over 15% per year, whereas total sales grow at only about 2.6% a year. In 2013, almost 1/4 of the company's revenue came from the specialty egg sales. Consumers are increasingly concerned about the health and animal welfare, and demand for specialty eggs has risen notably. Cal-Maine has shrewdly taken advantage of increasing consumer demand for specialty eggs. Moreover, specialty eggs offer high margins and less cyclicality than normal shell eggs. Specialty eggs are expected to be one of the most important drivers of the company's growth. Cal-Maine's management has referenced 10 to 15% growth a year in this segment. Cal-Maine's second key strategic imperative is growth through acquisition. Cal-Maine is a serial acquirer, successfully integrating 18 different operations since 1969. Cal-Maine offers the prime exit strategy for a generation of family-owned farms. Cal-Maine has the resources, expertise, and desire to acquire. Likewise, Cal-Maine has the reputation within the industry to be able to close deals. By acquiring companies, as opposed to solely expanding production facilities, Cal-Maine does not disrupt the supply and demand of the industry or run the risk of oversupplying the market and hurting prices. With acquisitions, Cal-Maine gets a larger share of the pie. Successful acquisitions and integrations are a key to Cal-Maine's stock price. Cal-Maine is not shy about their desire to acquire. CFO Tim Dawson said in our site visit that ideally Cal-Maine would acquire a 3 million or so hen facility every 3 months. That said, Cal-Maine does not chase acquisitions. In large part, future earnings growth is a function of acquisitions, and acquisitions are a function of smaller farms deciding to sell. Cal-Maine cannot control those variables. Making consistent acquisitions is a goal, but not always an achievable reality. Cal-Maine is a financially healthy company. At the end of fiscal year 2013, Cal-Maine's long-term debt stood at $65 million. That said, Cal-Maine's cash stood at over $180 million. Cal-Maine knowingly has debt capacity. At the end of the day, debt capacity and cash on hand is the gunpowder for their acquisitions. One interesting aspect of the company is how they distribute dividends. 1/3 of the company's net income is distributed quarterly through Cal-Maine's dividend policy. If a particular quarter has a net loss, no dividends are issued. The policy makes for an unpredictable dividend structure, but does align the company's financial health and profitability with rewards to shareholders. In our valuation, we used 4 methods: discounted cash flow, price to earnings, price to book value, and enterprise value to earnings before interest, taxes, depreciation, and amortization. We decided to give a higher weight to the discounted cash flow method than to any other multiple because Cal-Maine does not have good publicly traded companies to compare it to. The discounted cash flow discounts forecasted free cash flow to the company at the weighted average cost of capital in order to reach equity value of the company. We estimated a cost of equity equal to 7.57% using the following CAPM inputs: 3.55% for the risk-free rate, 6.7% for the market risk premium, and a beta of 0.6. The pre-tax cost of debt used was 6%, and with a liquidity premium of 4%, we got to a weighted average cost of capital equal to 11.4%. Additionally, we assumed a terminal growth rate equal to 3.55%, which is in line with expected future nominal GDP and population growth. The discounted cash flow method yields a 12-month target share price of $51.95. We forecast earnings per share in the next 4 quarters to add up to $3.51. Taking the comparable PE average of 17.51, this valuation method generates a share price equal to $61.45. Multiplying the estimated Cal-Maine book value per share of $24.86 by the peer average of 2.58 results in a share price of $64.14. The peer group enterprise value to earnings before interest, taxes, depreciation, and amortization average is 8.86, and Cal-Maine's 12-month projected EBITDA is $163 million. Throughout this valuation method, Cal-Maine's enterprise value is $1,443 million, and we arrived then at a share price of $64.37. Based on the weighted average of the 4 valuation methods, we reached a 12-month target price for Cal-Maine of $57. Our investment thesis is based on Cal-Maine's ability to absorb volatile feed prices, increase growth of specialty egg production and sales, and continue to pursue prudent growth through acquisitions. Based on this analysis, we reached the stock as a market perform with a 12-month price target of $57. In conclusion, thank you for reading and listening to this report. And please remember, the Burkenroad reports are produced solely as an education program at Tulane University's A.B. Freeman School of Business. The reports are not investment advice, and you should not rely on them in making an investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investment. Thank you for your time.